Welcome to the deep dive. We're here to cut to the noise and get you those essential insights. Today, we're diving into Zen Technologies Ltd, their latest financial results. Now, understanding these reports, it's absolutely crucial, especially for a company in the defense sector. Give you a real sense of their health, their future path. Our mission, simple, unpack their Q1 results. That's for a quarter ending June 30, 2025. We're looking at both standalone and consolidated numbers, plus what the auditors had to say. We want to pull out the important stuff, the key nuggets, so you get informed fast.
Exactly. And, these aren't just numbers. Not really. They tell a story about operations, strategic direction, market position. It's those insights, the ones beyond the headline that we're after today.
Okay, so let's kick things off, the formalities first. Zen Technologies Board, they met Saturday, July 26, 2025, right on schedule. And the main thing, the
Yeah.
big outcome, they looked at and approved the financial results for Q1, the unaudited ones, both standalone and consolidated.
Right. And it's important to stress these are prepared following Indian accounting standards and AS and also SEBI regulations. That's not just jargon. It means they meet specific, pretty rigorous standards, adds a layer of credibility right away, consistency, comparability, all that.
Absolutely. So keeping those standards in mind, what did the results actually show? Just at the glance for Q1 FY26, let's start top line. Standalone revenue from operations, ours, 11,105.79 lakhs. Now, for anyone wondering, a lakh is 100,000 rupees. So that's over 1.1 billion rupees, about 30.3 million US dollars roughly. Consolidated revenue from operations was higher. Ours had 15,821.87 lakhs. And profitability, standalone net profit, ours 3,711.89 lakhs. Consolidated net profit, RS 5,307.49 lakhs. So quite a noticeable difference there between standalone and consolidated, particularly revenue. What does that signal straight away about the core business versus the whole group?
Yeah, that's a good spot. The consolidated view, it brings in the subsidiaries, everything under the Zen umbrella. It gives you that wider picture of the group's health, its reach. The fact that consolidated is significantly higher, especially revenue, well, it clearly shows the subsidiaries are pulling their weight. They're adding quite a bit to the top line and to the profit, too. It suggests, a broader footprint than just the main Zen Technologies entity, diversification or maybe expansion.
Okay, right. Let's unpack that a bit more then. How does this Q1 stack up against, say, previous periods? If you look at standalone revenue again, Q1 FY26 was at 11,105.79 lakhs. Compare that to Q4 of last year, FY25, which was 29,349.85 lakhs. And Q1 of last year, FY25, was 25,395.66 lakhs. Now, the consolidated view, Q1 FY26, we had 15,821.87 lakhs. Q4 FY25 was 32,497.33 lakhs, and Q1 FY25 was 25,461.07 lakhs. So we're seeing like a seasonal thing for Zen or something else.
Well, it's important to remember Q1 often looks different from Q4. That preceding quarter, Q4, that's usually the end of the financial year, right? Companies often push to close deals, finalize contracts before year end. So you can get a bit of a surge in Q4, that quarter-on-quarter drop, pretty common. What's maybe more telling, especially for a defense company like Zen, is looking year on year, Q1 this year versus Q1 last year. And yeah, we still see a decline there. That could be down to project timelines, maybe delays in getting contracts rolling, or just the natural cycle of big defense orders. It's definitely something to watch in the coming quarters. See if it's a blip or more of a trend.
That makes sense. Okay. What about the cost side? Expenses. Standalone total expenses for Q1 FY26 were ours, 7,746.51 lakhs. And consolidated total expenses came in at ours, 10,332.21 lakhs. So I've got the big picture numbers. Right. But what does this mean for shareholders? Let's talk earnings per share, the EPS. What do these tell us about profit per share, especially looking back?
Sure. Standalone basic EPS was RS 4.11 for Q1 FY26. Compare that to RS 9.45 in Q4 FY25 and RS 8.88 in Q1 FY25. So, down, mirroring the profit trend. Consolidated basic EPS for Q1 FY26 was RS 5.31, again down from RS 11.89 in Q4 FY25 and RS 9.31 in Q1 FY25. But there's a really key detail here buried in the notes of the financials. It says the weighted average number of shares used to calculate EPS actually decreased. And it says this is, quote, consequent to accounting for treasury shares in the standalone consolidated financial statements, which, quote, resulted in increase in basic and diluted EPS.
Ah, okay. So that brings up how a company's own share activity can, well, influence the reported EPS. You mentioned treasury shares. Can you break that down? How does that work, and how did it specifically bump up Zen's EPS this quarter?
Right. So think of treasury shares like this. The company buys back some of its own stock from the market. When it holds those shares itself, They aren't considered outstanding anymore. They're not floating around with the public investors. So the total pool of shares shrinks. Now, if you have a certain amount of profit, let's say it stays roughly the same, but you're dividing it by fewer shares. Well, the earnings per share number is going to look higher. Mathematically, it has to. It's a financial management tool companies use. But yeah, it can make the per share profit look a bit stronger than it might otherwise. And for Zen, this accounting treatment definitely contributed to lifting their basic and diluted EPS figures this quarter, despite the lower overall profit compared to prior periods.
Interesting. Okay, let's shift gears a bit. Beyond the quarterly numbers themselves, the report gives us a look into Zen's strategy, their future outlook. First up, the order book. Absolutely vital for seeing what's coming down the pike revenue-wise. Standalone order book, orders 605.97 crores as of June 30th. And remember, a crore is at 10 million rupees, so that's over 6 billion rupees, about 73 million US dollars. Significant. Looking at the whole group, the consolidated order book was RSO 754.5x crores, even bigger. Now, an order book like that, it gives great visibility, doesn't it? How much does having those long-term contracts sort of de-risk things in the defense world?
Oh, it's hugely important. Hugely. Defense contracts, they're often large. They stretch out over time. Lots of lead time needed for building things, delivering them. So having a solid order book means you've got a clear pipeline of work already lined up. That translates into more predictable future revenue. It smooths out some of the bumps you might otherwise get from relying on, unpredictable government budget cycles. For Zen, this size of order book signals strong momentum, business health, and yeah, a degree of stability looking ahead. It's like knowing your next few meals are already planned, cooked, and waiting.
That's a good analogy. Okay, speaking of strategic moves, there was a big acquisition mentioned. Zen Technologies bought a 76% stake in TISA Aerospace Private Limited, paid a 6.56 crores for it. This was approved by the board back on June 21st, 2025. Happened through buying shares and converting some debt instruments, compulsory convertible debentures. So bringing TISA into the fold, how might that change these consolidated numbers going forward? And what kind of capability might TISA add to Zen's, arsenal?
Well, an acquisition like this, it strongly suggests they're either expanding what they already do or maybe strengthening a specific area within their core business. TISA Aerospace is now officially listed as a subsidiary in the consolidated financials, so it's fully integrated into the group structure. Typically, for a defense tech firm, buying another company means getting hold of some specialized tech, maybe new product lines, or perhaps just better access to certain markets or customers. It's likely a move to enhance their overall offering, make them more competitive, maybe grab a piece of a market segment they weren't in before. Could definitely boost those consolidated figures down the line.
That makes sense. The report also notes they transferred some shares, 4,260 equity shares, to employees under their stock option plan, ESOP 2021. It's pretty standard stuff, right? Aligning employee interests with the company's performance.
Exactly. Standard practice. Gives employees skin in the game, motivates them, links their own success to the company's growth. Pretty straightforward.
And it's worth hammering home. Zen Technologies operates in just one business segment, defense and homeland security. That's quite focused, isn't it? Putting all your eggs in one basket like that. What are the upsides and downsides of being so specialized in a sector like defense?
Yeah, it's a great point. The big upside is deep specialization. They can really focus their R&D, their expertise, become true leaders in their niche. That's a huge advantage in a complex field like defense tech. They get to know the customers, the regulations, the tech trends inside out. But the downside is exactly what you said. All eggs in one basket. Lack of diversification. Their fortunes are completely tied to defense spending, government policy shifts, the whole geopolitical climate. If defense budgets get squeezed or priorities change, boom, it hits their entire business. So incredible depth, yes, but also concentrated risk.
Right, but it does simplify the analysis for sure. They also listed out all their subsidiaries and associates that get rolled up into these consolidated statements, Unistream Tech Solutions, Zen Technologies USA, Brave Robotics. It shows the structure within that single focus. Okay, now let's talk auditors. These results came with review reports from Ramasamy Kodaswara Rao and co-LLP. Understanding the auditor's role here is interesting. You mentioned earlier the difference between a review and a full audit. Can you remind us what that means for how we should read their report?
Yeah, it's a critical difference. A review engagement, which this is, it's less comprehensive than a full audit. In a review, the auditors do things like ask management questions, perform analytical procedures. Basically, they look to see if anything jumps out at them, suggesting the financials might be materially misstated. It provides what's called negative assurance. They're saying nothing came to our attention. An audit, on the other hand, involves much deeper testing, verifying balances, checking internal controls. It aims for positive assurance these financials present fairly. So, a review offers some comfort, but it's definitely a lower level of scrutiny than a full audit.
Got it. And the conclusion for Zen's Q1, what did they actually say?
For both standalone and consolidated, they basically gave that negative assurance. They stated that based on their review, nothing came to their attention that made them believe the financial statements haven't disclosed what's required or that they contain any material misstatement. So, essentially, from their limited review perspective, things look okay.
Okay, sounds generally positive. But like you said, nuances matter. And the auditors did point out a few things important for our deep dive. For the standalone report, they noted one branch's financials weren't audited or reviewed by them. Nil revenue, small loss. Management signed off on it, and the auditor specifically said this didn't change their overall conclusion. Fair enough. But for the consolidated report, this is interesting. They explicitly stated they did not review the interim financials of 10 subsidiaries and one joint venture. And these unreviewed entities, they represent a pretty big chunk. Ours 4,716.09 lakhs in revenue, ours 1,830.88 lakhs in net profit. Though also ours 1,901.34 lakhs in total comprehensive loss. They also noted a tiny share of loss from two other unreviewed subsidiaries that management considered immaterial. So why is this so important for us, for you listening, to know what the auditors didn't directly look at, especially when those numbers are pretty substantial? What should that make us think about?
That's a fantastic question, and it really highlights the nature of a review. Look, it's not automatically a red flag, okay? Doesn't mean anything is wrong. But it is vital context. A full audit gives you that external stamp of verification on the numbers. A review, being less extensive, well, it relies more on management systems and representations. When significant parts of the consolidated group, like these 10 subsidiaries and the JV, are explicitly unreviewed by the main auditor, it means, for those specific parts, you're relying more heavily on the company's internal reporting and management's assurance. The overall report gets the auditors limited assurance based on their scope, but you need to be aware that a sizable portion of those consolidated figures didn't get that same level of external check. It means your confidence in those specific numbers rests more on your confidence in Zen's internal controls and reporting for those subsidiaries. It's just a difference in the level of assurance you have for different parts of the business. It might make you wonder about the consistency of controls across the group, perhaps.
Right. So context is key there. Okay, let's pull it all together. What's the big picture takeaway for someone tracking the defense sector, maybe looking at investments, or just trying to stay informed?
Well, this deep dive into Zen's Q1 shows a company that's, actively managing its finances. It's making strategic moves like the TISA acquisition. It's maintaining a pretty healthy order book, which is crucial in defense. They operate entirely within that defense and homeland space. The auditor's review gives some assurance, but also, importantly, highlights the limits of that review, which is good transparency. It paints a picture of a focused company navigating the specific challenges and opportunities of a very specialized market.
Yeah, definitely. And the report itself, it just underlines that sort of steady operational rhythm you see in defense tech board meetings, results approvals, managing stock options, integrating new companies. It's all part of the process. So we've walked through the complexities of Zen Technologies' Q1 FY26 results, pulled out those key figures, the strategic bits that really stand out. Hopefully you've now got a much more solid handle on their recent performance.
And I think this shows how a company's financial health, it isn't just about the profit and loss number, is it? It's also about strategic choices, agility, and how well they're positioned in a sector like defense, which is so driven by long-term government projects and, frankly, global events.
Absolutely. So here's a final thought to leave you with. We talked a lot about numbers today, financials, orders, but in a sector as critical, as strategic as defense, what other non-financial things beyond the balance sheet might be really crucial for understanding a company like Zen's true long-term potential and its impact? Something to think about as you continue your own deep dives.